This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. I'm proud to say that this Rask podcast episode is brought to you by PIMCO, one of the world's leading fixed income investment managers. With more than 50 years of experience in navigating complex global markets, trillions of dollars under management, and a global team of experts, PIMCO is a name trusted by investors worldwide. Discover how PIMCO can help you build a more resilient portfolio at pimco.com/au.
Welcome back to another episode of the Australian Retirement Podcast, where we talk all things retirement, lifestyle, and productivity. Glad to be in the room again with James O'Reilly. It's always so much better when we're on real cameras, not online, as much as we all enjoy a good Teams meeting. But good to see you.
I don't enjoy any Teams meeting,
at all,
yeah,
anymore.
It is bloody good to see you too, mate. Hello.
And I think we're almost going to have to change this up front. We talk about the banter that we start at the beginning of these. We almost have to change them to James's vent. I feel like that's a better direction that it's taking. We've covered some really interesting topics in the last few weeks, and today we're going to open up with something that's been all over the news, like everywhere for some reason or another. But the government is currently in the middle of their productivity commission. Can you tell me more about this and what the hell is going on? Are we productive? Are we not productive? Surely AI is making our lives easier and more productive, or are we just using less brain power?
We're using less brain power. So this is huge for Australia. It has really broad ramifications.
You heard that here.
Huge. Yep. Let's not throw words around. This is big. And the reason that it is because Australia is comparatively unproductive to how it's been in previous generations, previous decades. And there's a lot of reasons for that. But it really is starting to create a big long-term problem. Low productivity typically means lower GDP, gross domestic product, and lower GDP typically means lower tax revenue. Yeah. And so we've got this challenge of aging Australians, which we've known about for a long time. That was, of course, let's go back to the 90s when we late 80s, early 90s when we introduced superannuation. The whole point of that was to try to offset this aging population crisis that we're going to have. Yeah. And we're now really in the belly of that. And the assumptions that were made around the people like you and I actually getting stuff done and being productive members of society, those assumptions are a little bit out. And the byproduct of that is, on a big scale, we are not seeing the overall improvement in Australia's economy and overall continual improvement that we would like to be seeing.
It's like producing the same level of economic growth from the same amount of people.
That's right.
On an average basis,
that's
basically.
Right. Yeah, correct.
And what's the problem?
Well, the problem is that then
Apart from governments have too much debt, not enough income.
The problem is that governments have too much debt and not enough income. And
from one perspective.
Well, we certainly agree that the governments have too much debt, right? We can't disagree there.
Yeah.
So if we are talking about this productivity commission, the whole point of this was to sit down and for the right people to sit down and talk about how we're going to improve productivity. Yeah. And this has really big ramifications, especially for retirees and pre-retirees.
Public servants talking about improving productivity.
Yeah, that's right.
Yep.
The only way.
And how many boffins are in the room when we do this?
Many.
Yeah.
Sorry
to those public servants that are productive.
I'm not sorry. So if we talk about how this actually impacts retirees, the risk that we have here, this productivity commission so far, as far as I'm concerned, the TLDR of it is we're not being productive enough. Tax revenue is down. Let's talk in part about how we would practically increase productivity, and much more so about how we can get more tax out of Australians in order to continue to move the economy forward. And there is a very large groundswell. There's a large argument that exists to say that retirees are too financially supported at a time when their wealth is high and they get a lot of free kicks in the form of tax-free allocated pensions and
housing costs nothing when they grow up, and
that's
and
right.
avocados too expensive. And
Correct.
all that sort of thing.
These are people that never went through any hardship in their entire lives. Everything was just constant free kicks. Everything was super easy, and
17% interest rates easy.
I'm sure that's how it was for them.
Yeah.
And now we're here at this point in saying, well, we've got a younger Australians, which we'll put in as, how old are you?
42.
So we'll say sub 45, for example.
Oh, there we go. I'll take that. Thank you.
I wanted to give you a couple of years to enjoy that title. So we've got younger Australians who inverted commas, doing it tough, where taxes are very high, cost of living is very high, and they're not really the conditions that inspire the working Australians in order to do their very best and therefore increase their own productivity. Yeah. Now, this commission is currently running, and the findings are slated to be released in December, and probably, given the majority that the Labor government has, probably in early 2026, we're going to start moving on some of these findings. Now, this is a real concern for me. More tax. The concern here, and the reason why pre-retirees and retirees need to follow this closely, is because there is a lot of rhetoric about trying to essentially find more ways to tax the financially comfortable retirees.
It's a super your house, isn't it?
Or correct. Well, yes, they're predominantly yes. Yeah. To tax super or to tax retirees, so that they can more easily fund for the younger cohort.
Yeah, I mean, it is massive. I've been trying to keep track of it as well, but it's still, as we can tell, it's kind of this constant backwards and forwards, and they're almost testing things in the media before they go off and execute them. So this is why negative gearing pops up. Someone asked me that the other day, and I said there's very little chance that they change negative gearing significantly, but I'm also like, well, it's a Labor majority. This doesn't happen very often. I think everything's got to be on the table.
Yeah, and by so much, the majority by so much that realistically they'd be very hard pressed to lose the next election. Even so, if you were going to bring brave policy, these are the next couple of years for it.
So, and just for those playing along at home, TLDR means too long didn't read.
Yes.
In the context you were using it. I had to Google that while I was online. I'm in with some of the lingo, but not this lingo. I just wanted to just let those people know.
Beg your pardon, everyone. There's a colon in there too.
Yeah. When the Productivity Commission report is going to be like 300 pages long, TLDR.
Yep. You just drop all that into ChatGPT.
Yeah, too long. And talking about too long did read. Weekend sport. It's, I think, for both of us, young children, the pleasure of having grandparents that are still around, able to come and enjoy weekend sport. But it's a lifestyle. I'm lucky enough to only have Saturdays at the moment, and basketball Saturday mornings, plus a bit of Friday night Auskick here and there. Mm-hmm. I'm dreading, and I'm not sure if you're there at the moment, and maybe this is, I think this is related to productivity. Sunday morning footy. Are you there yet?
No, not there.
Not yet.
Lou and I are dividing and conquering for Grace's ballet class and Finn's soccer game. Yeah. So that's it. And luckily that's an early Saturday morning type thing. You're home by 11 and then you can be a functional member of society again.
I think it does impact on lifestyle significantly. And this is one of those things where I'd like to remind my children when they're older that I did spend every Saturday or every Sunday in the rain watching winter sport.
Yep. Did you steal any hats while you were there?
No, I didn't. Maybe this podcast will go viral. Who knows? Tell me more. For those who haven't been.
If you haven't been following it, you go to whatever source you want to go to and look for the video for the US Open. A CEO who with a tennis player is signing autographs. He's just won the match. He goes to hand his cap to like this poor little boy who's just like his eyes light up and he's so excited to take the cap. And this bloke reaches straight over his shoulder, grabs the cap, rips it off him, and then stuffs it in his bag. And
the kid's face.
Oh my Lord. So yeah, there are things that you can't do. Like with kids, go to kids' sports, tick. Yeah. Steal their hats, cross.
Don't tick.
Don't do that.
And I think, and obviously you don't want to go viral in retirement either. I think there's a good takeaway here. You don't want to be, I think he was still working when he did it, but try to avoid going viral unless you own some sort of media channel that allows you to monetize it. Yeah. And it's probably a completely different story.
To be fair, he might be an imminent candidate to start listening to the retirement podcast based on that. Yeah. I'm not sure how he's going to hold down a CEO role after that. That was a schmozzle.
And continuing with the boomer trend, so So we've bashed boomers in the opening as we tend to. Not that we're bashing them, but more like the rest of the country is bashing them for tax breaks or whatever it happens to be. But you've got a bit of a tip here where we might be able to extract a bit more money for retirees and for those heading into retirement or starting a pension.
Yeah, I'm on the other side of the coin. I want you to have more money.
Yeah,
much more. And
like any good financial advisor would say.
And this is one that we see very, very, very often, and it's potentially a huge missed opportunity because it is free money that most people overlook.
Yeah.
And that is what happens when you transition your portfolio, your superannuation from an accumulation account to an allocated pension account.
Yeah.
Now, if you have a wrap facility, which is more, or if you have indeed an SMSF, but let's keep it simple. Let's say you have a wrap facility.
Like Colonial First State, Hub 24.
Correct. Yeah, precisely. If you have one of those, then most Australians, you might have a portfolio, some of which, some assets have gains, some assets have losses. And you might have some positions in particular that have really significant losses depending on how speculative you were with your portfolio. Most Australians, when they get to the time to commence an allocated pension, would roll their superannuation or like all of it over into an allocated pension and say, happy days, because moving from accumulation to pension, there's no CGT on anything. Perhaps your overall portfolio, let's say for simplicity, is 500 grand. There was a capital gain of 100 grand. And so all of that just gets washed away. And now I've got 500 grand in pension, no CGT. That's a perfectly viable solution. But if you have losses inside your portfolio, that's not the best thing for you to do. What you're typically much better to do is to sell down the positions in the portfolio that have losses, especially meaningful losses, even if you intend to hold that asset over the long term. And the reason is the way that wrap facilities navigate tax, especially around the area of losses.
Yeah.
When you make capital gains, then of course the wrap facility will charge that, and there's a benefit. When you make a capital loss, then inside the wrap facility, they can't carry forward losses for you because it's a trust, and it's an enormous trust with a huge number of investors. And so that particular platform has made a loss rather than it getting allocated to your account to offset future capital gains. So the way that they way to fix that is that they pay you the tax loss, like the capital loss, in like the inverse as if you had have made a gain.
Yeah.
So if you held an asset that was worth 50,000 and then went down to, for example, $1, just indulge the hypothetical. If we did that and you roll that into pension, well, then you'd have $1 and that would be the value.
Yeah.
But if you sold that in accumulation mode before moving to pension and then rebought it in pension, you would have lost, you'd show a loss of 50K
benefit,
and then a tax refund of around 5K would get paid back to you. Then you roll the money into pension phase and now rebuy the asset. You're still $5,000 better off than you were before.
There's only superannuation wrap platforms, isn't it? Not investment, if you hold an SMSF via an investment version of the platform, or it still operates.
That's right.
It's custodial.
Yeah, thanks for making that point. Actually, at the beginning I said SMSFs, and I'm sorry if you followed along here. As I think about it more, it wouldn't work for an SMSF because that would have the loss contained within that portfolio.
And I think this is something that's deep in your PDS or your product disclosure statement. That this is why you pay an advisor to get into the detail of what's the most benefit you can extract from the transactions or the strategies that you're executing at any point in time.
Mm-hmm.
This is a super interesting takeaway, and platforms are, I think, around a third of the size of the superannuation industry as well. So completely, I think there's, if you're looking to do this and you've got an advisor, make sure they're having a look at this before they get started.
Yep.
Interesting one I had this week was a family that wanted to catch up. Their mother had passed away, and they had the resources available to understand what you do when someone passes away. No will, died intestate. But at some point, you actually have to close down, like lodge a final tax return. And there's a complexity around when does it become the estate of that person? How do you then distribute it? Who's responsible for the tax that is so? If they're holding investments, do you then distribute each of the investments out individually in equal shares, or do you just sell it, pay the tax within the estate, and then lodge a final tax return? So it can be quite complex, or it can be quite straightforward. So we went through this with a family, and it's happening more and more, particularly for those in retirement, in their 50s, 60s. That's usually when you're, depending on how old your grandparents are, or your parents are, that's when your parents are starting to pass away and you're starting to have to deal with these things as well. So, but basically the executors are responsible for the tax of the estate that has to be completed, and a final tax return needs to be lodged once all the assets are distributed. And one thing to always be careful of is when you distribute money, if you're doing it before you've lodged that return, you need to be prepared to put it back if there's a big tax payable. And in some cases, I've had examples where like 5 years of tax returns hadn't been lodged when someone comes to us. So you then have to look at unlodged tax returns in previous years before you can lodge the final one.
Dislodged.
Dislodged. Bringing the banter today.
Thanks for watching this episode of the podcast. A common question that we get at Rask is, how do I need to be prepared if I want to see a financial advisor? There's a few things that stand out that may really help you if you want to get the best from an advisory relationship. The first is to come prepared. It's really valuable if you can arrive at that meeting with a good sense as to what you want to achieve from an advisory relationship. Now, there's lots of different financial advisors out there that operate very differently. And if you don't have a good sense as to what you want to achieve, it can be kind of easy to get pulled into their advice philosophy and their approach. It can be hard to define what is the best advice relationship for me. So whether it's you and your partner having a good conversation to say, what do we actually want to get out of this? That will really, really help you to know that you're in the right place when you sit down with your advisor. The second one is to be open-minded. You may very well work out that there is one or two specific things that we're looking to address with our financial life. But a really good financial advisor is going to be thorough. They're not just going to look at those things. They're going to be as exhaustive as they can be about your entire financial life and make sure that everything is lined up and set up the way that it should be. So when you go into that process, please be open-minded that the highest value that you might get is not necessarily solving those one or two acute things that you wanted. The last thing is to be curious. If you are watching this podcast, it's probably because you are watching or listening. It's probably because you want to learn more about your finances. You want to level up when it comes to your education. And if you're going to meet with a financial advisor, it may be your first opportunity to transition that general knowledge that you've developed about your finances into your own situation and how it applies to you. So be curious. It makes sense for you to try to understand as well as possible, how do all these things work for me? Because at the end of the day, it's your financial journey and it's your money, and all of the advice should be helping to serve your unique situation. Now, if you want to learn more about how to get the most from your advisory relationship, you can either scan here, and that will take you to a guide that gives you a heap more information. Alternatively, if you scroll down below, there is a link to a Northeast Wealth page that we put together not too long ago, and that similarly outlines the key things that you should be doing in order to get the very most from the relationship. Thanks again for watching this episode of the podcast. I'm James O'Reilly from Northeast Wealth. We hope you enjoy it.
That takes us to today's big question.
No. Hang on. We're going back there for a moment.
Right,
so just
you're going to quiz me here.
With these estates momentarily. So
the estate can run forever.
Yeah, it can. So let's imagine for a moment that let's give you a hypothetical. We've got Sarah and Tom. Unfortunately, Sarah's mother has just passed, and they had, she has considerable assets, not just a family home, but
share portfolios,
all that sort of stuff. Yeah, that's
BHP.
Fine. Let's also, for the purpose of the question, let's imagine that there was no will.
Yeah.
What are the sort of challenges that Tom and Sarah are likely to have here?
Oh, this is very difficult. So when there's no will, you always have to apply for probate to be able to release the funds that that person owns, or to change ownership of their property, or to change ownership of shares. To get probate, you basically have to go through the entire court process. It's extensive. I think it's taken this family as much as 12 or 18 months to do that. And it was quite simple. It was a house and a portfolio of liquid assets. So it was quite a simple structure, but they had to apply to court. They had to engage lawyers. They had to write up all the appropriate documents. They had to all make an agreement. And then you finally get probate. And then you can finally deal with this actual distribution and closing up the estate. So it's one of the biggest things we talk about with every client. I'm sure it's the same with you and with every family. Every time we provide one upfront advice, but then ongoing advice, we always review estate planning. It is so costly and can be so stressful if you don't have a valid will in place. Just from the perspective, you can't actually operate on anything if there isn't an executor, and anything you do can be questioned by other people if it's not under the terms of a will or if it's been sat on and confirmed by a court.
Now, more often than not, under that scenario, let's talk about Victoria, because that's where we are right now, of course. So we've got a body here, state trustees, and then state trustees would typically accept responsibility of, if there's no will, of reaching conclusions around where that money should go, and how the money should be distributed. But also, state trustees charges a pretty hefty fee, right? Like when they become custodian of all of those estate assets, their fees
2 to 4% sometimes.
It's pretty meaningful, and then not to mention that, of course, they're on their own clock. And I don't want to be critical of state trustees in terms of their time frames, but just so much so as to say that there's lots of Australians that die without a will, and they've got a lot of work to do, and so. Not only do you lack the certainty around what's happening to the money, more so, but then also the time frames are really meaningful, and the cost can, especially for
while it's being managed, while it's being
it's there's absolutely no winners in not having a will, if you have even the most basic of financial situations, right?
Yeah, 100%. I mean, that's a great point to add on at the end as well.
And lastly, you talked about, I'm not going to let you off so easily, by the way. The last one is around that idea that you can run an estate forever, which of course is true. So can you speak about, we've spoken in the past about estate planning and talked about the idea that you've got 3 financial years to wind up an estate.
Yeah.
Now, after that, you can actually you may continue to let it run, but in most cases, Australians would
try and close it up.
Try and close within those 3 financial years. So what's different about the first 3 financial years versus after that?
I think you're actually going to stump me on this one.
Yes, finally.
We rarely do this.
What a treat.
But what I can do is ask
you're welcome to do that
on the way through. I can imagine that the 3 financial years is basically trying to incentivize families to deal with all the assets and ensure they're appropriately split and distributed, as opposed to letting it drag on in perpetuity. So it's fine if you've distributed a lot of the assets and you've got maybe one property that can't be sold and you're keeping that in there for a while. But the government wants these things kind of dealt with, and I also believe there'll be some tax benefit in doing it. The government's never going to do it without any tax benefit. So whether it's forcing the sale, forcing the transfer of assets, or moving those assets into someone else's taxable name, as opposed to being in its own marginal tax rate.
I feel a bit guilty here because you actually, this is just that you're stuck in the camera. You're like a deer in the headlights because you've actually told me the answer to this question before, so I know you know it. It's that if after the 3rd financial year you lose the tax-free threshold.
Yeah.
So that's the motivation. So there could be some crazy scenarios where you might have, Tom and Jane, Sarah and Tom, they might be they're beneficiaries at highest marginal tax rate, for example. And there might be a scenario where it's it's actually better temporarily in the estate for longer to keep and take advantage of a lower tax rate.
That's the incentive, isn't it?
That's right.
Get it out of there.
But in most cases,
force them to do it.
most cases, without that tax-free threshold, you're walking headfirst into a higher tax rate, and then in theory, you might even be better distributing it and putting it in a company versus leaving it inside the estate. So it'd be quite rare that you'd put the money there.
Yeah, exactly.
Yeah,
and then you've got the complexity that can come with testamentary trusts, where those assets are then passed to a trust, which is then managed for the benefit of different beneficiaries. But we've covered that in previous episodes. So I will finally allow myself to get into today's big question, where I get to grill you.
Okay.
This is a question from You Never Lose Your Kids. My son is looking to buy a home and we'd love to help him where we can. We probably have around $100,000 that we could contribute. But we've also heard, so that's cash, assume bank of mum and dad we're talking about here. But we've also heard that we can put our house up as collateral via a guarantor arrangement. Would this be better for us? James, over to you.
Oh, hello there.
So what's the bank of mum and dad?
Well, that is, let me open my bank account and why
what do you need?
What do you need?
Usually comes around the time of weddings and house purchases.
Yep. We've done this modelling for a few members in the past and one quite recently, and was quite surprised to learn that if the risks are something that you're willing to accept, then the guarantor arrangement can actually be a really successful way of supporting your kids.
Yeah.
Now, the way that it works, a guarantor arrangement, you can use your equity or equity in your home basically as the deposit, or as the appropriate deposit that your child or someone needs in order to buy that home. The banks typically, in order for you to purchase a property, they want you to show 2 things. The first one is income, and which often is called serviceability. How easily can you service the debt? And then the second is equity. So how much of your own money have you got stumped up here to make this work? Now, more recently, we've seen the government step in for first home buyers with a 5% government guarantee. That was covered on another Rask episode, not the Australian Retirement Podcast, but it was covered by Alex Luck, I think. And no, it was, I think it's Australian Finance Podcast. So that was quite recent, worth checking out. But I note that in this case, without knowing where they are, one of the challenges with that 5% is the deposit scheme is the limits around property prices. So in Victoria, though, I think the limit from recollection is around $900,000 or thereabouts.
Yeah, like significantly lower than the Sydney.
Yeah,
which was
correct.
Super interesting.
Yeah. And now that said, depending on what the ambitions are of your son here, if your son is looking at a property that's worth $1.2 million, for instance, then they don't have access to that scheme at all. Yeah. So that's something for you to consider. You could easily say, we can't help you, but what you could do is lower your expectations in terms of this first price and buy something that's within the banner of the scheme.
Good luck with that.
Yeah, good luck with that conversation. I'd love to be the fly on the wall for that one. So then what you can do here is from an equity perspective, you can say, well, let's imagine we're purchasing for simplicity, $1 million property. So the bank is going to require equity of at least, typically, to avoid lender's mortgage insurance, around 20%. Yeah. So that's $200,000. Let's imagine here that your son has saved some money. I'd strongly advocate around no financial support if your children have not shown a pattern of saving, for like an extended pattern of saving well. But if they are in a position where they've done that, then perhaps they've saved enough to cover all the stamp duty and transaction costs, etc. In that scenario, what would happen is for your house, you would essentially have a mortgage against your house.
Whoa.
It wouldn't be a mortgage that you have to pay for, but the embedded inside, like your house is essentially, is sort of locked within the confines of your son's loan. Yeah. So the $200,000 of deposit now is coming from your property and getting tipped in here. Now, your son is still going to have the full loan, which would be the full $1 million, and he'll need to be able to service that debt. But the bank is satisfied from an equity perspective because in a worst case scenario, it'll get covered.
And what's the normal, I don't think you mentioned it, what's the normal LVR that they're looking for to get it up to?
Ideal, well, there's different schools of thought because the lender's mortgage insurance increases the lower the deposit you have.
Yeah, from 20% downwards. Yeah,
that's right. When I plotted it years ago and it hasn't changed, typically our view is that if you've got a deposit of over 12% or like 12% or higher, that's like the right ratio in terms of lender's mortgage insurance. Yeah, in the sense that saving that last 8% to go from 12 to 20 could take their son, in this case, could take a year, whereas the lender's mortgage insurance is only like 1% of total purchase price. So it's a very low number relative to what it can be. At peak, it's about 4.5% or thereabouts.
And what's the worst case scenario here? What happens when things go wrong?
Okay, so the son buys the house and then says, I'm really enjoying this, but I'm not going to change my financial behaviors at all, or I've just been made redundant or quit my job and I can't, I'm stuck. In this scenario, if the bank were to foreclose on this property, then they would tap you on the shoulder for that $200,000. Yeah. Now, you could conceivably stump that up in cash. There's the money. Or alternatively, you could sell the house and therefore have the money made available there. Yeah. But the worst case scenario is that you're in this situation, depending on the
you're
value
on the title of the house, are you? You have to force the son to sell.
Correct. So this gets quite murky. Yeah. Having said that, I have seen times where it works. One of the obvious things that stands out to me is that not everyone has the money to support their kids with a casual $100,000, for instance. But a guarantor loan, especially if your children have shown really good financial habits, have stable jobs, are financially responsible, those sorts of things, and hopefully it's not the full amount. We're talking about 20%, as in you've got only the transaction fees and stamp duty saved. Hopefully you're further ahead than that. But in a scenario whereby you can contribute in a smaller way, hopefully property price growth alone should, as it continues to grow over the next 4 or 5 years of your child just servicing that loan, not paying it off more aggressively, but just servicing it, will mean that eventually the loan will come down with minimum repayments and the value of the property will grow up to the extent whereby suddenly the loan to value ratio on this property is naturally below 80%.
And that's the question of how do you get out of it?
at that point, you would ask your son to refinance that debt and to do it and remove you as the guarantor on that loan. And that the speed of that is ultimately going to vary based on your son's income, how quickly they can make repayments, if they've got any other cash coming in. Like, for example, they might have an inheritance coming in the future or one of those sorts of things.
Property prices keep flying, then they'll be okay.
Fine in 6 months.
Okay, pretty quickly. And I guess one of the questions here would be, can the guarantee doesn't have to be for the full value of the property. It could be for a singular amount, can't it?
Correct. Yeah. So, and that's that $1 million to $200,000 scenario. A lot of people look at this and say, "Oh, but if something went wrong, I'd lose my home." No, not necessarily. You'd be on the hook for the whole deposit.
For $100,000.
Yeah, and whatever the amount is. Now, so as part of that, in a scenario where you're either offered $100,000 or to rephrase, you chose to either give $100,000 cash, scenario 1, or guarantor, scenario B. Yeah. If the guarantor amount was for $100,000, for me personally, I'd take that option. I would like my child to have the responsibility of the full loan, and I get to keep all of my own money.
Yeah.
And in a worst case scenario that is default, then I'm going to be on the hook for, you guessed it, $100,000. Yeah. So you're back where you started. Now, of course, there's other ramifications. Yeah, that's right. There's other ramifications in terms of, again, having your home put into this deal, and what that might mean if you want to downsize or do something different in the future. But all that said, I think in the right scenario, this can be really beneficial.
Yeah, I think there's probably one last question. It seems like we always get the most niche questions. We work with quite complicated and quite often bank mum and dad families. So the question would be, can you help from superannuation? A lot of people have a lot of wealth in superannuation, maybe a property in there as well. Is that something that you can possibly do from superannuation to help your children?
You cannot.
Yes, there we go.
Yeah. So let's move on. Yeah. So, and the reason being, I mean, firstly, it breaches what's called the sole purpose test, which is that all activity inside the superannuation fund should be for the retirement benefit of members, and you'd be the member. But secondly, there's a prohibition around financial assistance and offering your SMSF property as guarantor for a child's loan is classified as financial assistance.
Yeah, fantastic. And there's a massive takeaway, because I think what we try and talk about and what we try and walk through is a lot of the mistakes that come. We have a bit of a running joke on this as well, but a lot of the tips and traps and the mistakes that come in retirement, and how do you avoid these kind of situations where you're giving up your lifestyle for the actions of or the impacts of someone else. So I think that was super valuable and great question from You Never Lose Your Kids.
Well, I'm going to add one more little bit, if I may. I'll take a few moments more airtime, which is that if you were doing this, like I've seen the other side of this, which is that we've been working with younger clients that want to approach their parents about it. And we put together essentially like a really thorough brief around here's the argument for why you should do it. And the fundamental things that we wanted to make sure that we got right, firstly, is that they are adequately insured.
Yeah,
that's a huge risk. And if you're going to have your kids do
Housing
this,
contents, yeah,
and not just that, but income protection.
Yeah.
If you're unable to work due to illness or injury, suddenly it falls on you and it's your problem, which is not fair. The second is that there should be a really clear track record of having saved easily enough to service that debt and then some, thinking about the potential for circumstantial change, as well as, for example, interest rate increases and any other of those variables. So if you are going to do this, don't be complacent. That you're looking to do your children a favor, and hopefully the issues or the potential issues with that favor will never materialize.
Yeah.
But if they do, it's going to have a horrible effect, or it could have a horrible effect on your relationship and also your own personal well-being. So be thorough at the front end. Be exhaustive. Ask if this happens, what are you going to do? What are your promises if we have this event and this event and this event? What have you done to negate the risk of A and B and C? Do all of that exhaustively at the front, because once you're in, you can't unwind it. Certainly not easily.
Yeah, and it's all about having those conversations at the beginning, and then there's a natural hope that your children live close to you. So we can kind of be drawn into that as well. That you want them to buy. They're used to living in certain areas. You want them to buy the house that costs more, so you have to help them to I think it's always everything. Every relationship is about being as upfront as possible when you're going into big decisions like this. And I think that's the perfect time to wrap it up. James, thank you for joining me on the Australian Retirement Podcast today. It's fun being the host. Super insightful. I think that, the going into the estate, the little tax back payment you can get from your wrap platform, and then
not stealing hats.
Not stealing hats. That's probably the biggest takeaway I've got from today. So thanks for joining us.
Absolutely awesome to be here. Thanks, mate.
And we'll see you all next Thursday.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.